We could see the second day in a row of losses after not having seen such a run in 30 sessions. 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, setting your kids up for financial success. We're going to speak to Mellody Hobson, the co-CEO of Ariel Investments, about her new book, Priceless Facts About Money.
And Bank of England Governor Andrew Bailey shares his thoughts on how to navigate the biggest risks in the global economy at Bloomberg's annual Global Regulatory Forum kicking off this hour.
Plus, GM hitting the gas pedal in its latest quarter as high prices boost profits. We'll dive into the numbers, all of that and more coming up. But let's take a look at markets. 30 minutes until the bells ring. As Matt said, of course, we are on track for back-to-back losses. We haven't seen that on the S&P 500 in 6 weeks. So we'll see if this downdraft holds. Currently down about 0.5% pre-market. A little bit more if you take a look at big tech. The Nasdaq 100 currently off by about 0.6%. A little bit of a rally in the bond market. We haven't seen that for a while. Of course, 10-year yields breaching 420, now coming down a little bit, but still relatively lofty, Matt.
Yeah, we were at 420 this morning. I am seeing a term premium in this market, and it's something that a lot of people are talking about. You're starting to see a steepening of the yield curve as investors worry about fiscal deficits and the debt. Remember yesterday, T. Rowe Price said we could see the 10-year yield over 5% in the next 6 months. So this is something that we're going to talk about again with Mellody Hobson today.
4.2%, Matt. You know how I feel about that. Now, some stocks to watch as well. We're talking about General Motors, down now 10%. They beat earnings estimates and raised its profit forecast. Demand is improving, but that is just how the market feels, even about a beat. Also, 3M raised its full-year profit target. Its new CEO boosting productivity for the industrial giant, now up about 4.7% pre-market. Danaher down 2.6%. It topped estimates this morning. But to the downside, we're watching even more downside still. We're watching GE Aerospace dropping. Supply chain limitations are weighing on deliveries. Now General Electric down almost 6%. Verizon also down after reporting mixed earnings and lackluster sales of new smartphones. The likes of iPhone 16 here, 3.6% lower pre-market. Lastly, Kimberly-Clark down another 5%. It cut its outlook after a revenue miss, and stores have lowered stocking levels for products. Matt, brutal day of earnings today.
Yeah, it's brutal in here. Speaking of cutting outlooks, the IMF lowered its global growth forecast for next year and warned of accelerating risks from wars to trade protectionism, even as it credited central banks for taming inflation without sending nations into a recession. It raised its forecast, though, for the U.S. In fact, the U.S. Was one of only 2 countries for whom the IMF raised its forecasts in 2024 and 2025, South Africa being the other.
There you go, 2 peas in a pod. I do think, of course, that's the good news, but you have to squint for it in this forecast. Of course, 2024 global growth is unchanged. That's expected at 3.2%. Then you look ahead, doesn't look too great for 2025, but like you said, actually upgrading the U.S. It sees 2025 GDP growth at 2.2% for the United States and South Africa, too.
It's interesting. The elephant in the room here, the elections, the U.S. elections are not mentioned in this report, but the meetings themselves are 3 blocks away from the White House. And not to mention the report itself, it does talk about protectionism, protectionist policies, and trade policies. Of course, that is a large aspect here of the U.S. political elections. But of course, according to this report, it is impacting more of the rest of the world, Matt, instead of the United States.
In fact, you shared a full screen earlier. I'm sure we'll have it and share it with our viewers at some point that breaks down the countries lagging and that are ahead. Mexico is a real trouble spot, and you have to wonder how much that has to do with this presidential election. Let's bring in Samana from Wells Fargo Global. He's a senior global market strategist at the Investment Institute. Samir, thanks so much for joining us. What's your take on growth right now? I mean, it feels pretty strong. Katie just said 3.2%, is better, I think, than the long-run average. How does it look to you?
Yeah, I mean, to your point, I think it's at a steady state, right? I mean, we went through kind of that EKG, as we call it, right? In terms of, the big drawdown into COVID, then the sharp, snapback thereafter, and now it's, kind of getting back to, probably the norm from kind of the 2017, 2018, 2019 timeframe. And it's more than enough for companies to generate profits. I think probably what would be, very surprising to a lot of investors is that, in 22 and 23, when, growth was pretty good, profitability wasn't all that great because you had supply chain disruptions and you had, a lot of things you were still working through. Now, as growth is slowing, what you're seeing is profitability is picking up and earnings should have a really solid 2024, and then they should continue that into 2025. And that's what we think will kind of power equity markets, higher, beyond the elections.
I'm curious how you would build a portfolio around this report that we got from the IMF, because as we walked through, I mean, globally, that forecast for growth coming down, the U.S. actually getting a little bit of an upgrade here. We've seen that the U.S. has been the standout in global equity markets. Is that still going to be the case?
Yeah, great question, Katie. And we've favored the U.S. now for years. And again, it has to do with, one, just kind of the systems in place in the U.S. Two, I think it has to do with, just the great configuration of companies that are geared towards tech and tech plus in the U.S. And, from that standpoint, it's just very difficult right now to say that will kind of shift. We're watching for it, but again, we're very skeptical right now. If anything, Europe's actually getting worse. Some of those downgrades to Germany and Italy, I think, are very much warranted. So we would still favor U.S. large caps. I think it's still very much a winner-take-all economy. We did, however, take the opportunity early August to upgrade small caps to neutral. Again, we do think there's some two-way risk there, and we remain unfavorable on emerging markets. Despite some of the measures in China, we think over the long run, it'll be very difficult as an investor to generate positive returns above those other equity asset classes in the emerging markets.
I want to pull up also this note from Citigroup this morning, this idea that you have investors looking particularly extended, particularly when it comes to futures markets. So through derivatives, people are positioning ahead as things have nowhere to go but up, Samir, for the lack of a better way to say it. How much risk is there at these valuations, even if you like those large caps?
Yeah, great question. I would say there's quite a bit of risk, and we've been saying for some time this is a great time to rebalance, especially with yields perking up north of 4%. We recently took advantage of the move in yields to actually get a little bit more constructive on the longer end of the fixed income curve. We were unfavorable. We took the opportunity to go to neutral. So again, starting to kind of lengthen that duration a little bit. If we see 4.25, 4.5, I think we'll probably continue to tilt in that direction, because when you have kind of starting valuations where they are right now, could you generate another, 6, 12, 18 months of positive returns? Absolutely. But then kind of that cyclical to strategic, outlook does start to get a little bit more cloudy with those starting valuations. So what we would say is this is a great time to immunize those portfolios by tilting a little bit of money from equities probably into fixed income, in a rebalancing type of fashion.
What about, steering away from the sectors that have done so well, from the big tech, for example, and buying into those that haven't done as well? How do you feel about smaller cap stocks?
Yeah, so we got a little bit more constructive there. I think neutral is the right place to be. I think the fact that they're just still struggling so much in the economy that, as it currently stands, with respect to the non-earners in the Russell 2000, I believe are in the neighborhood of 40 to 45%. A lot of private equity, firms are taking some of the higher quality, smaller caps kind of off the board. So you just have a very kind of, mishmash of kind of smaller companies that are in the Russell 2000 at this point, which is our benchmark. So neutral is probably the right place to be. We do like energy. That's our most favorable sector. It's a great hedge against inflation coming back, against geopolitics. We also like industrials, financials, and communication services. So very much a cyclical portfolio, maybe not as geared towards technology. And then we don't like staples and we don't like utilities. Those are areas that will continue to struggle due to higher commodity prices, due to higher interest rates, due to higher inflation. So we're, I guess kind of our mantra right now is anything but defensives is the way to position.
And Samir, we don't often do this on this show, but I do want to talk about the bond market a little bit, since you said that you've taken opportunity of recent moves to maybe get more favorable on the long end. You take a look at the 10-year Treasury yield. It's higher by nearly 60 basis points since the Fed cut rates in September. That is the biggest post-Fed rate cut move since the Fed cut rates in June 2003, if Bespoke Research is to be believed. What do you make of that? I know, of course, that you're adding here, but where do you think fair value actually is?
Yeah, I mean, it's not surprising given the fact that the Fed was largely doing what they termed as a risk management move. I mean, it's just common sense, right? If you take the risk of a recession off the table, which is what a risk management move is, then by default, you should see the longer end start to kind of, creep higher because, again, they tend to do best when there is, slowing growth and or a recession. So, I would say here kind of in this 4 to 4.25 range probably is fair value. Where would things get really attractive or interesting? I would say, not too far from here. I would say, again, we started to lengthen now, but 4.5 to 5. I know there's some out there who see 5%. If we were to see 5, we would be in the camp that you're not going to see it for very long, and you should absolutely take advantage to make sure you have your duration kind of on the longer end. Not here so much, but especially if you were to get to 5.
All right, Samir, always great to speak with you. Appreciate your time this morning. That is Samir Samana. He is Wells Fargo's Senior Global Market Strategist. Meanwhile, a quick check on these markets less than 20 minutes to go until the opening bells. And boy, it's ugly out there. The S&P 500 down about 0.6%. Of course, that volatility coming through mainly in big tech right now with the NASDAQ 100 currently off by about 0.7% pre-market. Your small caps faring roughly the same. The Russell 2000 currently lower by about 0.5%. Now coming up, one of the most powerful women in business, Mellody Hobson, joins the show to talk about financial literacy, market volatility, and the election trade. That conversation up next. This is Bloomberg.
While the majority of Americans own stocks in retirement accounts, only 34% of those surveyed by the Fed said their plans were on track. And famously, nearly 4 in 10 Americans have enough cash saved up to cover a surprise $400 expense.
Don't have enough cash.
Yeah. And we don't learn nearly enough about saving money and investment in this country, but Mellody Hobson hopes to change that. Mellody Hobson is the co-CEO of investment firm Ariel Investments, out with the New York Times best-selling book for children, Priceless Facts About Money. Hobson is also on the board of Bloomberg Philanthropies, the philanthropic organization of Michael Bloomberg, the founder and majority owner of Bloomberg LP, which owns Bloomberg News. And thank you for joining us here, Mellody. This book in particular, you start with your own experience growing up in Chicago with a single mother who sometimes was looking to make ends meet. Now you stand on the board of multiple boards of Fortune 500 companies. In a lot of ways, is this book very personal to you? Is it a memoir of some sort?
It's not a memoir. I thought my story was very important in the beginning to grounding the book, but I also shared John Rogers' story, who founded Ariel, just as a beginning, setting the stage of why the book makes sense and inviting the reader into our lives as we were children, explaining what it was like when we were children. For me, money was such a big deal when I was a child because we had such a hard time making ends meet that I felt that letting the reader know why money became so important to me as a subject matter was something that they would then appreciate my passion for the subject.
Something we were talking about was this idea that only about half the states in the United States really teach financial literacy, require it when you go to school. How might that change over the next couple of years? Do you think that there could be a bigger push here to get financial literacy taught in schools?
I'm hopeful. I don't know that there's any trigger that will lead to that. I was really happy to hear that the state of Maine actually bought my book for every elementary school student in the state. I was astounded by that, and I thought that's great because we want children to have this knowledge, and honestly, I want the children to be the gateway to the parent. I'm hoping a lot of parents will pick up the book and be astounded by the facts that they read and think, I need to do more and learn more, because most of our money habits are learned from our parents.
Right, and most parents don't talk to their kids, don't feel comfortable talking to their kids about this stuff. I know mine didn't. So that's a piece. The book is a piece. Hopefully getting it into schools is another piece of it. Is there a holistic, a healthy model? Can you look to another country, another civilization and say, they've done that right and we need to sort of adopt those practices?
I wish I could. The world is pretty financially illiterate. The subjects of money and investing, other than counting, we don't go very far in schools in most places. And I know there are things, home ec and classes like that, but I think we need to go a lot deeper, really understand the fundamentals of the stock market and investing. When you think about the fact when you get your first job, you look at that 401k plan and you have to make decisions that ultimately affect your family's financial security over the long term in terms of your retirement. And no one's really trained you to think about how to make those decisions.
Yeah, and hopefully you're doing that when you get your first job, because it took me over a decade before I finally started to invest my earnings. You know?
Well, so many companies now are automatically enrolling their employees, so that helps a lot. That inertia, once you get into that plan, you keep investing. That's a great thing. But we have to make sure when people change jobs, the average American has 13 jobs in their lifetime, that they don't change jobs and cash out every time that they move. And there's such interesting data about that. The Wall Street Journal did a great story yesterday on it about the fact that the smaller the amount you have in your 401k plan, the more likely you are to sell it. The bigger the amount you have, the more likely you are to roll over.
Yeah, it's fascinating. And the experience of switching jobs and seamlessly getting your 401k across, still a clunky process. But with this book, what I think is interesting is that, of course, you go into the history of money thousands of years back. But I'm curious if you thought about future-proofing this at all, because you walk through a sample bank transaction. Do you think things could look different in 20, 30 years when the children who are reading this book are actually applying these lessons?
Well, we hinted at some of it. First of all, I don't think knowing the history changes anything. I think that's actually great and really important, and it's fascinating. I mean, just explaining things like, you know, precious metals are the results of meteors hitting the Earth's surface. I mean, most people don't think about that, or fossil fuels, or dinosaurs. You know, there are lots of things there that I think no matter who you are, whatever time we're in today or 30 years from now, but will be great. I hint at some of the things to come, and I talk about, for example, paying with your phone and hint at some of these other things, and I think that we will see. However, it doesn't change some of the fundamental ideas that I think are important. For example, I'm encouraging parents to use cash around young children, because these concepts are incredibly hard to understand. They're mystical when you see money spewed out of a machine like an ATM, or you see your parents only paying with plastic. And so a lot of parents will tell me their children will say to them when they say, we can't afford this, put it on a credit card, which suggests they don't understand the fact that the credit card is something you have to pay, or that money is finite. So no matter where we are with how money and exchange and all of these things work, decades from now, hundreds of years from now, I think this foundational information is still very important and probably very evergreen.
Or the concept of a 25% interest rate, right, for the credit card. You know, it's interesting. Goldman came out with a note in the last couple of days saying that the next 10 years for the S&P 500 might not be as good as the last couple of decades. If you are a young person investing $1 today, if you are worried about the next 10 years, how do you think about investing?
So first of all, I think that that's a nuanced argument that Goldman is making. I saw the report, and I think top line, they are right. However, the driver of the S&P over the last decade, as we all know, has been a very narrow group of stocks. We know the Mag 7 has had an outsized effect on the returns that we've seen there. And so I often think we have the S&P 500. It's really the S&P 493, and then the Mag 7 that has turbocharged those results. So I would say I'd like to be a bit more nuanced in thinking about that return in the future. And I think there are areas of the market that are very undervalued, where we have the opportunity for real appreciation over the next decade. If you look at how smaller company stocks have done versus large cap, the Russell 2000, or where we live at Ariel, the Russell 2000 value versus the S&P 500, there is a gaping hole in valuations right now. Right. And we think, therefore, there's a tremendous opportunity for smaller cap stocks to have returns that are more like what we've seen historically if you look back to 1926.
Before we get to the small caps, and I know
I'm itching over
Katie
here.
champions the small caps for us on this program.
Yay!
I just want to know what your take on that report, because I feel like if we're kicking off this decade with NVIDIA, you know, and Facebook and Microsoft and Amazon and Alphabet in the S&P, that's a great start for this decade. And then if you get OpenAI and SpaceX and start adding these innovative companies, I mean, it seems so pessimistic for Goldman Sachs to forecast only a 3% annualized rate. As we showed on the chart that I cribbed from DataTrek, that has only happened like in the Great Depression or the financial crisis. I mean, only when horrible catastrophes happen do we get returns that low for a 10-year period.
And that's why I say I'm not necessarily convinced. However, the stocks that you mentioned, I think they're priced for perfection. I think you can be a great company, and I mean great, and not necessarily a great stock. And I think it presumes that everything goes perfectly. And I think that is very hard to accomplish over long periods of time. I was very humbled when I read stories in the last few weeks about Boeing and Intel, where you see what is happening there. When I came out of college, Intel was the Microsoft, the NVIDIA, the Andy Grove was, superstar, legend. So the idea that that company is a $100 billion market cap, I never would have anticipated that. And yet, that is where we are, because life happened along the way. So again, you can be a great company and have things happen. I'm not suggesting any ill will on these businesses or these companies. I'm just saying from here, if I'm, as we are at Ariel, looking for value, I would look elsewhere, because the risk of owning the names does go up with these valuations.
Right. So the margin for error is super narrow if you're one of these huge, magnificent seven.
I mean, I read the story about, Tesla having a $6 trillion market cap at some point. You have individual stocks that represent the market cap, one stock of the entire Russell 2000. I can't even wrap my brain around that.
Yeah.
And in terms of what that means, the kind of stocks that have been orphaned along the way, and therefore the opportunity that exists. And the concentration takes the risk up. The S&P 500, to me, is a large cap growth index now.
Well, let's build on what you were saying about small caps, because we were having conversations yesterday about, one of our guests said that small caps are in a secular bear market. And part of the reason why is that you have high interest rates, you have these companies with big debt burdens, and many of them in the Russell 2000, just the normal one, for example, are unprofitable. So talk us through your base case there, how you were able to square that circle.
So I don't think that has changed from what we've seen in the Russell 2000 historically. Many, not all. There are great companies in the Russell 2000 Value Index that are not unprofitable businesses, that are wonderful businesses that have great potential over time. But the market has basically ignored those stocks, and therefore there's been no action in them. But it doesn't mean they don't have great futures. There are companies that do things that are very specific. Just because you aren't a T these days, a 1T, a 2T, a 3T, doesn't mean you don't have a wonderful niche business that can grow. And we have many of those in our portfolios, from cruise ships to, all sorts of consumer products companies that are the best at what they do.
So, another thing on the near term, I know we're thinking about long-term investments here as well, but we are just really days away from the U.S. election. The elections are on the top of minds of many investors at this juncture.
2 weeks from today.
2 weeks from today. My gosh, it's a heavy reminder. And so how do you think about the election and the impact it would have on the markets?
It's interesting. I think that it weighs on a lot of people's spirits and their psychologies. But at the end of the day, I've bought into our idol at Ariel is Warren Buffett. And Warren Buffett has been known to say markets are stronger than governments. And so I think that we've seen that time and time again. If you look back over the last couple of decades and seen the different leaders that we've had run the United States, the market has not been felled by any one person. And I think that's a testament to the fundamentals of the U.S. economy, and that ultimately that is what will drive returns. So while there's a lot of talk about markets and what will happen as a result of who wins, I think I'm more confident, and I'm a long-term investor. We have a turtle as a logo. I always have my turtle. I'm more confident in the long term that the U.S. economy will do what it always has done, and the American capitalist system will work.
So I also want to ask you about Kamala Harris for a minute here, because I know that you've personally signed a number of letters that have come out in support of her. What is it about her that you think that the business community may not be understanding? There are a lot of Republicans who will come out and say that she is not the best for business. What would you say to that?
I think she's probably more moderate than people think. I think there are a lot of assumptions that are made by association. I think one of the things I've been very confused by is this idea that you be a clone of another person that you work for or with. I was president of Ariel when John Rogers was CEO for many, many years. We are now co. We are very different leaders, but we are aligned in our core beliefs around values. We make different decisions all the time, and that doesn't make one of us better than the other. We're different. And so I think that when she's in the top seat, when you are the boss, it's very different than working for someone. And technically, when you're vice president, you work for someone. So it'll be, I think the assumptions that are made about who she is, those are yet to be fully revealed, but I am encouraged by what I've heard so far.
You know, we talk a lot about the things that are wrong with this country, and Harris and Trump talk about that too, and we really focus on the risks. I wonder, you know, with a book like this, looking forward, hopefully with hope, what does the U.S. do right? I mean, you've had such success in your career, and the companies that you foster have had such success, I imagine, in large part because of the U.S. environment. So what does this country do right?
Oh, my gosh, we do so many things right. I love America. I think we are the best country in the world. And that's not based upon some manifest destiny point of view. It's just the facts of, if you look at just at the market level, people want to be invested in the U.S. That's where they see the opportunity. If you look at some of the quintessential American things, hope. Americans are always very hopeful. I think that's a wonderful way to be. If you look at things like charity, we are the most generous nation in the world. Literally, no nation comes close to us in terms of looking after each other and giving back to our society. If you look at opportunity, despite the fact that people do not yet have the full opportunity that I believe they should have, especially those who are Black and brown and those who are women, we are not yet fully at the table in any way. Despite that fact, we are still better positioned than a lot of other places in the world. And you can be me. You could be someone who grew up the youngest of 6 kids, whose mom was struggling all the time, who got evicted and cars got repossessed and phones got turned off, and you can go to Princeton, and you can be on the board of Bloomberg Philanthropies and on the board of other companies, and you can run an investment firm. Now, there was tremendous hard work that made that happen, but there were some unique aspects of America and what makes America great that allowed luck to come together there as well, and for me to happen. And I think there's the idea that we could have more melodies is what this book is about and what our country is about.
Is there a warning kind of under the surface here, too, about as we kind of get into this recovery era? Do you worry at all, Mellody, about a K-shaped recovery?
I mean, again, we're bottom-up stock pickers at Ariel. You could spend a lot of time worrying about a lot of things. I have this quote that says, worrying is like sitting in a rocking chair. It gives you something to do, but it doesn't take you anywhere. I try to just think about what I can control, what I can do. And we try to have, at least at Ariel, in terms of our portfolios that are resistant to different types of economies.
All right, Mellody, that's a good place to leave it. Really appreciate you taking the time with us today. That, of course, is Mellody Hobson, and her book, Priceless Facts About Money, is available now. Meanwhile, we are 15 seconds away from the opening bell, Matt, and it looks like we're going to open on a down day.
Yeah, it does. And after a down day yesterday, so as you were pointing out at the top of the show, if we have red arrows here at the close, that'll be the first time we've had back-to-back losses in 30 sessions or in 6 weeks. You heard the opening bell there at the New York Stock Exchange, LATAM Airlines ringing the bell there. Interestingly, we have Chicago Atlantic BDC. I say interesting because Mellody obviously comes from Chicago, ringing the bell down at the NASDAQ. Let's get a look at how the major averages are shaking out. And we have a ton of earnings today. They're going to move the needle. You have General Motors beating expectations. You have General Electric disappointing a little bit. So how will that shake out? And obviously, we've seen some volatility throughout the session, Katie. But what are we looking at right now as the live trade kicks off? Right
now, about 40 seconds into the U.S. trading day, it's shaking out to the downside. You have the S&P 500 off by about 0.4%. We were down 0.5%, 0.6% pre-market, so holding these losses right now. Same thing, too, if you take a look at big tech. Really, your laggard in this market, down about 0.6%. Small caps, relatively resilient, but still a down day, down about 0.3%. And we know that we had losses yesterday, and it was the small caps that led those losses. So we'll see a lot of daylight between now and 4 p.m. But let's take a look at what's going on at the single stock level. And we start with 3M raising its full-year profit target for the second time under its new CEO, who has helped to boost productivity for the industrial giant. You can see that boost to shares right now, currently higher by about 3.5%, Sonali.
Also, Katie, keeping an eye on GE Aerospace, another company out with earnings now down almost 6%. Shares are slipping as supply chain limitations weigh on deliveries for the jet engine maker, Matt.
All right, yeah, that's an interesting report. We're going to dig deeper into that. I'm obviously focused on the other general in the room, and that's General Motors. Raising its profit forecast, at least the bottom end of its profit forecast, because demand has improved in the U.S. for the high-margin vehicles that it makes, the big trucks and the SUVs. Those are offsetting the losses that General Motors has seen in China, and they're also not doing as badly, I think, as everyone else with their EV strategy. We're going to get back into that in just a moment, though. Right now, I want to turn to the Bloomberg Global Regulatory Forum. There, the Bank of England Governor Andrew Bailey is giving the keynote address, and it looks like they're all getting settled in. We'll bring you any updates that we have from this forum from Governor Bailey as they cross the terminal. And you can also, I imagine, watch it if you have a Bloomberg terminal in front of you on Live Go. So type LIVE Go if you want to hear from Andrew Bailey.
I'm sure many people do. So, of course, we have the terminal functions to do that. We'll continue to track this market as well. Really interesting juncture in markets, of course, on track for back-to-back down days for the first time in 6 weeks. We'll be back in a moment. This is Bloomberg.
All right, we want to get you back with great anticipation to the Bloomberg Global Regulatory Forum, where the Bank of England Governor Andrew Bailey is giving the keynote address.
An approach that becomes more like a sort of disaggregated laundry list of potential risks. Macroprudential policy must focus on the system-wide risks, taking into account correlations, concentrations, opacity, interconnectedness. It's actually a more ambitious and harder to pull off approach. It tends to wane as a tool in its popularity as a tool, and as Klaus was making this point, as memories of the most recent crisis fade. And you tend to see a reversion to the more list-like approach. And I think we have to lean against that. We do have to keep this focus on system-wide risks and ground what we're doing. So, my first message today is that I think taking the macroprudential approach matters. It's harder, but it matters. Second message, come back to Cassandra. So Cassandra was fated by the god Apollo to utter true but unbelieved prophecies. In FS speak, she was dedicated to one tail of the distribution. She may have missed her vacation as a central banker. Maybe the disbelief was because, as Minsky would have said, memories of financial crises, memory of any crisis fades fast. And as Klaus said, I'm afraid this is evident now in the memories of the global financial crisis 15 years ago. Memories are fading. People sometimes say to me, well, you've solved that. We can relax. But the work of theory and history is timeless, and it warns us, actually, you can't fall into complacency. We must always debate levels of regulation. That's the right thing to do. The debate about growth and competition is the right debate to have, but we can't ignore the timeless nature of financial stability. That's the second message. The third message really focuses on the critique Minsky made of what was actually post-war Keynesian economics, though not actually Keynes himself, and the point that money and finance matter together because of their interaction and its potential to cause instability. Now, before the global financial crisis, there was a debate that centered around a question that was much too limited, which was, were we in a world of asset price bubbles or not? That sort of ignored all the interconnections. Now, as Klaus said, since the crisis, the global scale of bank and non-bank finance has shifted towards the latter. And so again, as Klaus said, rightly, we've had to shift our focus. Now, we've increased bank regulation. That was an absolutely necessary thing to do coming out of Pittsburgh to reflect the crisis. But macroprudential risks in the non-bank sector have not originated just because of the shifts we've seen in the last 15 years towards it. They were there in the 19th century, actually. So this is a lesson that we've seen before. But the shift, and this is the third message I give, that relative shift towards non-banks since the financial crisis makes these risks more pressing, even though they're not new. Now, the non-bank world and its interaction with banking, money and finance, has evolved in ways that require us to look beyond regulation to surveillance and the tools of remedy. So my fourth point is about surveillance. The non-bank sector is large, it's disparate, it's opaque, it has complex and hard to observe interlinkages, it has hidden leverage, as Klaus was saying. In the banking sector, one of the big tools we developed after the crisis was stress testing of banks. Those stress tests are institution specific, though they actually, in doing so, we seek to capture system-wide risks. But in the non-bank sector, we have to focus, in the spirit of Minsky, on how risk spreads, to identify the points of weakness in markets, in infrastructures, and in firms. And issues like leverage are the way in which those weaknesses become apparent, but it's the spread, it's, if you like, it's the flow of risk that we have to be more focused on in the non-bank world. So at the Bank of England, we're conducting our first, what we call system-wide exploratory scenario, which is designed to do this. It's designed to simulate shocks and observe their effects as they flow through the system. It's not institution-specific in that sense, it's a flow test. We're going to report the results by the end of the year. So my fourth message is, I think we are reaching a pivot point where, and I thoroughly endorse Klaus's point that we've got to implement the remaining rules and regulations, but we also need to develop better surveillance tools for this world, where flows matter and points of blockage matter. Now, you'll be pleased, I hope, to know that my fifth point is the last one. And that's about the tools that we as authorities use in a crisis. I made the point earlier that surviving extraordinary crises can require extraordinary measures. And sometimes we have to solve short-run situations with measures that are not consistent with long-run stability if they continue to be used. But they are necessary nonetheless. You have to do what you have to do, as Klaus said. Central banks provide last resort liquidity to the banking system. That goes back, of course, a long way in history. Now, that liquidity is rightly focused on the banking system. Money is unique. Money must hold its nominal value. What I call the singleness of money, whether it's provided by the central banks or it's in the commercial bank system, holding those two things together with constant nominal and real value is absolutely crucial to the centrality of the money system. And so if a central bank injects money into the banking system, it's to do that. Now, historically, it's also because we believe that if we inject money into the banking system, it will, I think to paraphrase the Heineken advert, reach all the parts that are needed to be reached. Now, I think the proposition that there is a unique and powerful relationship between central banks and banks holds true throughout. The third point I made, I think it was the third point I made, will injecting money into the banking system always reach all points where it's needed? I think is much more open to question. Now, I'm not going to talk a lot about LDI, contrary to Klaus's invitation, but that was one of the key challenges we had in that case. It wouldn't have worked. So I think the growth of the non-bank sector has given us as central banks the challenge. How do we meet that challenge? How do we meet that challenge in extraordinary circumstances of getting liquidity into the non-bank sector? But we do not compromise the fact that the relationship between central banks and banks is unique in terms of the value of money. What that means is banks are always able to come to the central bank for liquidity. Non-banks don't have a right to come to the central bank for liquidity, but there are times when we have to provide it. And I think we've learned that we have to provide it on a more systematic basis as an emergency tool. In other words, we have to say, this is what we will do if there is an emergency. And in saying that, we then have to be prepared, in a sense, to be good to our word, when we judge there to be a crisis. And so that's, again, to finish, what we're doing at the Bank of England. We're designing tools and putting them on a more, if you like, consistent basis to say these are the tools we will use for non-banks in a crisis, but they are not standing tools of liquidity provision in the way that we do it with the banking system. So to sum up, we have a very big agenda. We have made a lot of progress, but I agree with Klaus, there's a lot to do, and we cannot let the fading memory of the crisis take away the importance and crucial nature of financial stability. So just to summarize very briefly my messages, system-wide matters must not be overlooked. We must heed the warning that memories of past crises fade. The shift towards non-banks presents renewed challenges.
All right, and you've been listening to Bank of England Governor Andrew Bailey at the Global Regulatory Forum. If you want to keep listening, you can go to LiveGo on your terminal. But meanwhile, let's get a look at the stock market. Of course, we opened 15 minutes ago, and we are still in the red here. The S&P 500 currently off by about 0.4%. The Nasdaq 100, your big tech stocks, coming back a little bit, but still down about 0.3%. Your small caps, of course, a wipeout yesterday, currently off by about 0.4%. A pretty broad-based sell-off right now. If you take a look at the sector level, you have 3 sectors that are higher. 8 are down right now, being led by a downdraft in industrials, materials, utilities. Your lone bright spots, of course, are consumer staples. You also have communication services and energy fighting to stay green right now, Sonali.
It's fascinating. A tough start to an earnings season. Of course, we have even more next week. But we're going to bring you a positive story. We're going to talk about GM next. Out with strong earnings, biggest gainer in the S&P 500 right now. We're going to take a look at the automaker next. This is Bloomberg.
Welcome back to Bloomberg Open Interest. A quick check on the market right now, of course, on track for back-to-back down days for the S&P 500. Haven't seen that in 6 weeks, and those losses certainly holding right now. The S&P 500 currently off by about 0.4%. Big tech going back and forth, currently down right now. The Nasdaq 100 lower by about 0.3%. And your small caps fighting to recover from yesterday's wipeout. Not exactly getting there. The small cap Russell 2000 index currently off by about 0.4%. Really broad-based selling going on at this moment. But it's time now for our top calls. Some of the analyst action in focus this morning, and we start with Bernstein, naming Walmart as its top pick in the U.S. retail category as it launches coverage of 7 companies in the space. The analyst says that Walmart will be one of the few retailers that can grow e-commerce profitably. Keyword profitably. Next up, Citi upgrading First Solar to a buy. The analyst says that the upcoming election is a catalyst for the stock, and if a Democrat wins, it could drive a sharp recovery in shares, while a Republican win would likely drive higher tariffs, resulting from a longer-term recovery. You can see shares currently higher by about 4%. And finally, we have BTIG saying that Decker Outdoors is no longer a buy, downgrading the shoe company to a neutral. The analyst sees slower start to the holiday season for its UGG brand, as well as moderating growth for its Hoka footwear as competitors catch up. Shares currently off about 2.3%, Nat.
All right, interesting note on Decker. I know that you have a Hoka story.
Many Hokas.
Yes, and we'll talk about that at some point. You know, we're going to get the CEO here and talk about what makes those running shoes better than other running shoes. One of the stocks we're watching this morning is General Motors. The stock jumping after the automaker showed solid demand for its highest margin vehicles, the trucks and the SUVs. GM also lifted its 2024 earnings, the bottom end of its range, to $14 billion from $13 billion in terms of EBIT. Here with more from Detroit is our bureau chief there, and he covers General Motors for us, David Welch. David, once again, GM beats, and it's been outperforming all year. In fact, over the last 2 years, outperforming the other American automakers, Ford and Tesla. What are they doing right? What do investors see here that they like so much?
The company is a cash machine. They have a solid product lineup, very good in some places, and they're getting, evidenced by the fact they're getting very good pricing. So look, in the quarter, GM sales were down 2%. A lot of that was at the fleet level. So retail did very well, and that means you get better pricing there. GM's average discount, I think, was 4.5%, and the industry was 6%. So while you're starting to see more discounting, largely because consumers are hanging back, waiting for interest rates to come down, GM did less of it. So average vehicle selling for more than $49,000. That's pretty expensive stuff, and they're making good money with it.
I was just going to ask that because it's interesting. If you look at the biggest gainer and decliner in the S&P 500 today, you have GM really on a tear today, but it's actually another auto parts maker that is the worst performer on the day. And I think it really speaks to what you're talking about, people delaying these big ticket purchases and a lot of weakness in the economy still. It's genuine parts that is down more than 18%. Why is GM able to stave off some of the storm at this juncture, David?
I think it's really kind of a lot of basic blocking and tackling. They've done a solid job of reducing costs. They said they were taking out $2 billion in structural costs, and they say they're going to hit that. And when you keep pricing up, that's a function of not producing too many vehicles, right? If you have too much inventory, then you have to kind of come up with a bunch of bribes to get consumers to come in and drive this stuff away. And they haven't had to do that. Stellantis has had to do some of it. We'll see where Ford ends up on that. Ford's actually done a fairly good job of maintaining price, too. But right now, that's where GM's growth is coming from because they're having a tough time in China and also South America, the other market where they're pretty big. And the U.S. is where they make all of their money. So even if volume's a little bit down, they're just keeping margins up. And you look at the earnings per share beat. A lot of that's driven by the fact that they've been buying so many shares back. They bought 250 million back just in the quarter, getting closer to that 1 billion share mark that they want to get below next year. But look, you can't buy back that many shares if you're not generating a lot of cash. And that's what the company's doing, and that's what the analysts like right now.
I have to say, it's really impressive to see GM shares up close to 8% right now. Their total gain for the year is close to 48% year to date when it comes to total return, really outperforming the rest of the industry mightily, also outperforming the rest of the market as well. But of course, they're reporting earnings with just 2 weeks to go until the presidential election. What did Mary Barra have to say about what trade policy adjustments might look like? GM's never going to stick their neck out in terms of, what one candidate or the other. But they're watching trade policy closely, and if they needed to adjust because of tariffs, China, they don't make a lot of vehicles there, but if there was an adjustment from Mexico, that would hit them because they make a lot of vehicles there and bring them here. But that doesn't seem to be in the offing. I think they'll, as long as it's not tariffs to Mexico, I think they'd be fine. You got some Buicks coming in from China, but it's not a lot. Maybe they have to bring that vehicle to China. Maybe they have to bring it to the U.S. But it's not something that hits them unless we're looking at a total redo of USMCA.
We might never notice if no more Buicks came in at all, David. The EVs, to me, is the most puzzling issue. We've been showing the Escalade IQ, really handsome vehicle, but GM doesn't seem to be taking the kind of hit that Ford is. We hear about these multiple billion-dollar losses at Ford, and GM seems to be navigating this well. Is that the right interpretation?
Oh, yes and no. I mean, GM just isn't putting out the number, the amount of money that they're losing the way Ford did. But what they did say in their investor day earlier in the month is that they're looking for next year to erase the $2 to $4 billion bogey that they have for EV profitability, which sort of implies that that's how much they're losing this year, $2 to $4 billion. But as they scale up, because remember, GM's they've got their own battery cell plants, and they've had this platform in the works for a long time. As they get scale there, they think they're going to be able to break even fourth quarter, first quarter on an operating profit basis, not total, but that's going to erase the drag on them from that.
We got to leave it there. That is Bloomberg's David Welch. We thank you so much for bringing us more from the GM story here. Of course, big mover today. We're going to give you another look at some of the earnings movers today. We're looking at GE because, of course, the aerospace business has been tough. You have GE now down almost 7% in the early trade. Kimberly-Clark down more than 4% now. And remember, organic sales really are not expected to rise very much. Organic sales for the Kleenex brand due to lower inventories also kind of muted here. 3M promising, but still down 2.7%. We're going to now talk to ECB's Christine Lagarde in the next hour. Stick with us ahead. This is Bloomberg.
We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Take a check on these markets about 30 minutes into the U.S. trading day. The S&P 500 currently off about 0.4%. We've been hovering around these levels. Same, too, if you take a look at the NASDAQ 100, currently lower by about 0.3%. The bond market, pretty quiet, of course, after the fireworks that we've seen over the past couple weeks. Your 10-year yield currently camped out at about 4.18, a little bit lower. We know that we got above 4.20 for the first time, I believe, since July earlier today, but currently breathing a little bit there. It's interesting when you take a look at this sell-off. As we've been saying throughout the show, of course, on track for back-to-back losses. Haven't seen that in about 6 weeks. There's breadth to this sell-off. Currently, you have close to 400 names lower in the S&P 500. Of course, we know that it's heavy earnings period right now. General Electric, one of your biggest decliners right now.
It's fascinating because even when you see companies beat on expectations or post fairly promising figures, you have 3M, for example, second raises here, 2 raises for a new CEO who just took over in May. You still see the stock down here. So fascinating to see just how disciplined, discerning these investors are getting in this market. But you know, one thing we were talking about this morning, Katie, that's fascinating.
Right.
You haven't seen 2 back-to-back rises in the S&P 500 of north of, for a year, a full year, of more than 20% since the 90s. So this year, where we are, is
the overall year.
For the overall year. So a little bit of a breather here for, you know, 0.5%.
Only a tiny bit.
Stunning?
Only a tiny bit, right? Because we did just hit a record high on Friday.
That's true.
Let's turn now to Washington, D.C. Bloomberg's Francine Lacroix is holding an exclusive conversation with European Central Bank President Christine Lagarde, and we'll listen in.
Well, first of all, very nice to be here with you, Francine, and with all of you here. So, in my position as head of the European Central Bank, what I focus primarily on is prices, price stability, inflation, and how it's evolving over the course of time. And at the moment, we are not totally unhappy with what we see, because it looks very much that inflation is on the right track of disinflation. You know, we come from very high numbers, as high on average for the whole of the euro area as 10.6%. And the latest reading we had for the inflation in September was 1.7. So, you know, those numbers are relatively reassuring. They are only a number, and we're not looking at one data point, as I have said repeatedly. We're looking at a lot of data to make sure that this disinflationary process continues to be well on track. But, you know, we also have to be cautious, and you know, we cannot jump to conclusion that, okay, done deal, we've broken the neck of inflation. No, and I think caution leads us to look at all the data that are coming in, whichever form it takes, whether it's survey indicators, as we had a lot of that in September, or whether they are more model derivated as when we have projection exercises. And we will be looking at that and continue to be data dependent, but of course, cautious and not jumping to conclusions.
So when you look at inflation, could you achieve your target a little bit earlier than expected?
That would be my hope. You know, if our target is 2% medium term, and I'm absolutely confident that we will reach that target sustainably in the course of 2025. Is it going to be early in 2025? Is it going to be very late in 2025? I think it really will be determined by data, by the state of the economy, by energy prices, by the transmission. You know, we look at 3 components. We look essentially at inflation outlook, we look at underlying inflation, we look at transmission of our monetary policy. And on the basis of that sort of 3 pillar analysis, we can assess whether we are definitely on track and when.
Do you think it's a little bit sooner? I mean, so we, of course, at Bloomberg look at every single word.
Yeah, no, I know. So I'll be quiet now.
First quarter, second quarter, or is it just too soon to say?
I think it's too soon to say because I wouldn't be loyal to our principle of data dependency if I was to tell you it's going to be on such time in the course of 25. I think we all, governors of the Governing Council, and I'm sure you will be hearing lots of them in the next few days because they will be on air very much. I think we are all confident that 25 is the year when we reach our target on a sustainable basis and with the medium-term caveat that I have mentioned. But we have to be attentive to everything. You know, we have energy prices that are low at the moment relative to where they could be. We have services going slightly down, but not much. We are still at 3.9% in the last reading, and we have to pay attention to domestic inflation. That is the segment of inflation that is proving resistant. And domestic inflation is largely based on services. Services in itself largely labor intensive. And we have to, as I said several times, we have to be very sharp in our analysis of the nexus between wages, profit, and productivity. That three-pillar platform will be very indicative of where services prices, which will inform domestic inflation.
You could have a situation where not all inflation indicators fall at the same time, right? In the next couple of months, would you still feel comfortable if only some of them reach 2%? With the trend going that way?
You know, if you want to have an average of 2% medium term, and you know that, for instance, the inflation of goods at the moment, at least, based on the information we have, is 0.4, by necessity, you will have other components of your inflation measurements which are higher than 2%, because we think in terms of average number based on the proportion of products, services in the inflation basket, if you want to call it that way. So not all elements will have to be at 2%. We will need to have headline inflation at 2%. That's the target that we have set for ourselves. But where you have a point, I think is we need to be as granular as we can in the analysis of inflation of services, because that is the one that is tricky and resistant. And we have to pay attention to what is sort of structural, what results from latest developments, what those latest developments indicate. Are those elements sort of what we call late comers? For instance, if you think in terms of insurance, insurance generally is, the premiums are renewed on an annual basis. Those are the ones that we call latecomers because they will increase their prices at the end of the year. We need to do the same analysis with wages. The beauty of Europe is that it is diverse, right? Okay. In some countries, they renew the collective bargaining agreement on an annual basis. So there is a relative regularity in the increases. In other countries, they will renew the collective bargaining agreement every 2 or 3 years. And there is a catch-up element. So we have to really, we have to do that granular analysis which will inform where it's coming from, how long it's been in the making, what is the catch-up element about it, and how lasting it is for the future. So we need to look at information from the past, which is relatively stable, to see how it informs our assessment of the future. We do all that.
But so if you look at the economic blueprint that we're seeing for the moment in Europe, so inflation is coming down, wages are rising, the economy seems to be holding up, but what's happening with consumers?
I would qualify I agree with you, maybe except on wages, because I think that wages is at a bit of a pivotal moment where, and it goes back to my granular assessment. If you look at compensation per employee, it is beginning to go down a bit. If you look at negotiated wages, depending on whether you include the one-off payment catching up or not, it's also moving in the direction of lower growth than what we have seen. So that leads us to think that this wage increase that could have led to second-round inflation is probably beginning to abate now. But coming back to your consumer point, that's a really interesting European phenomenon. I think our narrative, the narrative that we gave in September, which is the fact that recovery will be driven by consumption because the real income that households have or that corporates have to invest has improved over the course of time, that still holds. The timing of that is being extended. And the European consumers certainly, in general, do not have the same propensity to consume than the US consumers. You know, it's often said that, oh, as long as the US consumers consume, the economy will do fine. The European consumers are not on the same page of active consumption, I would say. And if I look at Q2, consumption has actually gone down a bit. Although real income, disposable income, had increased. And savings in Q2 again had increased. So it's as if, on average, the European consumer was sitting there looking at his real income increasing, looking at the world out there, looking at the war at the doorstep of Europe, looking at developments in the Middle East, looking at the political uncertainty around and thinking, well, I might be better off saving a bit more. And who knows, I might cut a good deal with my bank because the banks are still offering not generous, but possibly attractive rates for time deposits, rather than consume.
Do interest rate cuts help with that? Should they actually, or is it transmission mechanism taking longer than expected?
I don't think so. I think gradually reduced interest rates are being transmitted, and our monetary policy is traveling to financing, to the activity, and ultimately to inflation. So it should encourage spending, whether by way of consumption or investment. But on investment, we're not seeing much at the moment either.
Are you expecting it to pick up, or are there particularly weak countries that give you worries?
Well, there are countries that currently are not performing spectacularly.
When are you expecting them to pick up again?
Well, I think a revision of the business model and a collective endeavor to support the economy would be helpful, including, public spending.
But there's no real sign of that coming in some of these countries.
Well, nécessité fait loi. Hein? I don't know how you translate that.
Necessity usually leads to something, which is the overarching point. Madame Lagarde, when you look at monetary policy, so the markets really expect quite a lot of incremental interest rate cuts until April. Are they right?
It's their analysis. As I said, disinflation well on track. Have we broken the neck of inflation? Not yet. Should we jump to conclusion? Or should we not be a bit cautious? And as data dependent as we have committed to be, I think is our determination. Now, markets have their own way of looking at things, and they're playing with other people's money, and the more they make, the better, I guess. So my objective is price stability.
So markets could derail a bit of that if they misprice things. Do you just ignore markets, or do you try and guide them?
No, we don't ignore anyone. We look at what colleagues do around the world, what impact it has on us. By necessity, we have to factor in to our models what markets anticipate in terms of rate curve but it's not to say that we are market dependent. Far from it. But it's a component that we take into account. Yeah.
What would it take you to do 50 basis point cuts?
I don't want to speculate. I think for me, the direction of travel is clear. And what we have done, starting in June, is I think the sensible approach, and one that should be continued with that caution element about it, not jumping to the conclusion that, because we've done 25, we'll do 25 in each and every time. No. Or because we think that it's going to be down or up or this, we'll do 50. I think that's, that's not called for, given how we are trying to really be solid in our analysis and be both data dependent, but also applying judgment and trying to look forward. And we need to scrutinize and be as granular as we can, because we are getting closer to the point where hopefully the economic situation will be in the right equilibrium. But to jump to conclusions and to, you will have people the whole week saying, it should be 50, it should be 25. No. Direction of travel, clear. Pace to be determined on the basis of backward and forward-looking element, using the 3 criteria and applying judgment. I think that's how I see it. But it's a collective endeavor in Europe. I'm lucky to have plenty of very smart governors around the table, and my executive board members. Everybody has a view.
Everybody does have a view.
Yeah.
When is the right time to start thinking about being less accommodative? I don't know how often you get asked about the neutral rate, or whether it just gets...
Very often and invariably I say, I don't know. Because it's not an elusive concept, but it's one that is, first of all, pretty complicated to articulate, and that is based on multiple factors, including productivity, aging, the impact of climate change, and all the rest of it. So if you were to ask me today, where is it? The honest answer is I don't know. I think fair to say, and credit to the research of the ECB, which is not the line adopted by either myself, the Executive Board, or the Governing Council, but I think their conclusion is that it's going to be lower than where it is today, and it's probably going to be higher than where it was anticipated to have been prior to COVID. So anywhere in between.
That's a big range.
I know it's a big range, but it's not like a mirage, but it's something that you can see, perceive, and identify the closer you are to that element. Because it's an equilibrium where you have the perfect economic conditions, employment at potential, growth at potential. But we are not there for sure, and we are still restrictive, and will continue to be for as long as it's needed to get to that point.
I know that your mandate is only inflation, but we had the Draghi report, of course, on competitiveness. It was pretty alarming.
Draghi is former president,
so he comes into your fold. I mean, he was pretty alarming, actually, in what Europe needs.
No, I think that he was alarming in his diagnosis of where Europe is at, and I think I said it was alarming and fair or just. I forgot what I used. Because I think that he has conducted, in his position as retired president of the ECB, retired governor of the Banca d'Italia, retired prime minister of Italy, he had this sort of paramount vision, holistic vision, if you will, of how Europe functions, what's missing, where are the gaps. And he had, a great team of economists and other experts who helped him and fielded his considerations and thinking, which is why I think his diagnosis is severe but just. His suggestions for the future in terms of what needs to change, what needs to be done, what reforms must take place, this is not alarming, or unless you say alarming because he's setting the alarm bell saying, now is the time to get on with it, please. And he's better equipped than anybody else to do that because he's been there, he's done it, he's seen the procrastination in play in those European leaders' council meetings. And I think I really like his report. I don't agree with everything that he says. And I think that our job now and the job of the Commission and the job of the European leaders is to filter out what can be done expeditiously without bumping into resistance and obstacles and territorial wars and turf discussions, to move the needle and to make sure that both on productivity, where there's a huge big lag, on a better energy sovereignty, on the fluidity of labor factor and capital, there is real progress. For my money, in my position, I would want those three components to really be addressed, because it would make a difference for the fight that we have against inflation.
I mean, there are a couple of, I guess, concrete points, right? There's a huge cross-border possible banking merger that could or couldn't happen. There's, he mentioned, the joint issuance of EU bonds. What would make
what he said, I think, on the latter point, because it's a controversial one.
Yes.
Let's face it, the issuance of European bonds, we did it once with COVID, and you have a whole bunch of European leaders who say, oh, it was a one-shot deal, never again. So it's a highly controversial element of his report, which is why it's being picked up by media and others. He himself said at the Bruegel Institute, which is pretty thorough and deep into these matters, he said, you can read my report, take my report, move on with it, and take ownership without that chapter. Forget about the debt issuance. If it's going to be a battle between the Nordic and the Southeast, and forget about that. But do the rest, and I think he's right.
Would you be in favor of bank consolidation to almost signal that actually Europe means business?
There's two particular. I think productivity is the key battle, but it's not directly related to what we do. What is directly related to what we do, because of monetary policy transmission, notably, and because of the financial stability without which price stability will be an illusion, is number one, capital market union, and banking union. Banking union, you can think of three pillars. Two have been built, and the third one is missing. So that's what, the EDIS, which is the European Deposit Insurance Scheme, does not exist yet. So every country is on its own, and that needs to be addressed. My colleague Joachim Nagel actually this morning committed a nice op-ed on that, and I'm delighted that he did. And capital market union, we have, in some areas, post-market infrastructure, we have 27 different backbone. That doesn't work. Or it does. No, I shouldn't say it. It works, but it is suboptimal by a long way. And one of the strengths of the US market has to do with the capital market that is vibrant, deep, liquid, and I think much more easily accessible than it is in Europe.
Is the window for Europe to get its act together narrowing? I mean, we also sit, if you're European, between the US and China. The IMF also.
You could argue that it's a strategic place to be in.
As long as?
As long as it is solid and strong enough to stand with its own sovereignty and its ability to keep the savings at home. That's one example. There is so much European savings that travel the world because they don't have an instrument or a market in which to invest.
But what are you optimistic about going forward? I know there's, we talk a lot about tariffs, we talk a lot about trade also being rebuilt now because of geopolitics instead of economic advantage. That must make it harder for Europe.
Well, first of all, there is a lot of trade that takes place within Europe. It's not necessarily well accounted for, but there is a lot of goods and services movement within Europe that can be improved significantly. And you need to look at the Letta report in addition to the Draghi report. And Enrico Letta, former prime minister as well, makes the case for better European integration. Remove some of the obstacles, do away with some of these multiple licenses to operate, the prior authorization here, prior authorization there, and have a real integrated deep market, one of the largest in the world. But we keep procrastinating about little boundaries everywhere. So that integration will increase, in my view, the trade that is within Europe. And I think it will also encourage investment in Europe because investors look at the general terms, the tax regime, but they look first and foremost, what is the market? Where will I sell? Is there a deep and wide market? What scale can I get as a result of my investment? So I think that a lot is in our hands. I don't like restrictions to trade. I'm a former trade secretary for my country in France, and I just know how much trade can bring in terms of competition, in terms of added innovation, in terms of elasticity. I think trade is helpful, but the trade conditions have to be fair. They cannot be constantly subsidized in a very opaque and unfair way.
I was going to ask you, so we recently had an interview with a US presidential candidate who said tariffs was his favorite word. Mm-hmm. I imagine because of also your background, former IMF, former trade minister, this is not your favorite word. What is your favorite word?
I think fair trade is a key boost for growth, for employment, for innovation, for productivity. And I would say that it's something that we should not throw away, because in any period of time where this country, the United States, has thrived, were periods of trade, not periods of I'm going to retire behind my boundaries and play at home. No.
I mean, there was a big UK media outlet that called the US economy the greatest economy on earth right now. I mean, would you agree with that? Where does it leave the rest of the world?
I think it depends where you are on the social ladder. I think you have to go further than look at the sort of aggregate numbers or the average numbers. It depends on where you are on that ladder. If you are at the bottom of the ladder, if you have small job, not much by way of income, I'm not sure that you think of, being in the first and best economy in the world. So everything needs to be considered. But it's a case that the US, for instance, has very high productivity, has a very vibrant tech sector, and has had it for a long time, so it has capitalized on it since the beginning of the 21st century, and that there is a lot of catch-up taking place at the moment. But I think you cannot look at that in isolation. You have to look also at the people. And I think if you look at the Gini coefficient, which is probably not the best way to measure inequality, the US is not doing so well from that perspective. So it's also a question of spreading and distribution so that all people can benefit. Sorry, I'm being political now, forget it.
But do you worry about central banks being political or being dragged into the political sphere?
No, because I think there is a huge resistance to that in the decisions that we make, despite what is being suspected here or there in any, place in the world. And I think for those central banks which have the privilege of independence, either by virtue of the treaties or the tradition, it's critically important to hang on to it and to defend it, because the credibility of an institution like a central bank really is a factor of how independent it is vis-a-vis the politics. And it's precious. It's very precious.
But do you think that you'll come under attack more? Not you personally, but just central banks. Donald Trump said, Jay Powell had the easiest job because it's a flip of a coin every month.
He should come and visit us. And I have thousands of hardworking people, economists, jurists, computer scientists, and I can assure you that they work super hard every day, not just once a month. And they are extremely conscientious and determined to really do the best job they can to deliver the right monetary policy and secure what is our common good, which is our currency. So we defend the euro and we fight for the euro, just as the Fed defends the dollar and fights for the dollar, I'm sure. I don't want to speak for Jay Powell, but I'm sure that's how he sees his job.
We're just kicking off IMF World Bank Week. What are you most looking forward to?
Oh, seeing my friends. That's the first one. And I'm not saying that just jokingly. I think that there is huge value in meeting people who are equally concerned, who have the common good at heart, and who will, inform each other of where they see things, what obstacles there are, how we can better cooperate. And it's some people say, oh, it's a big talking shop. Yeah, but it's better to chat than to war, as Churchill would have said. And cooperation, with the caveats, with the difficulties, with the temptation of protectionism and all the rest of it. But cooperation is at the very center of keeping some sanity in this world.
I mean, the world is so complex. If there was only one thing that you would like to figure out this week, what would it be?
Peace.
One question.
Peace. If you ask me one word, that's the one that I would use. Because when I was IMF managing director, I have seen the destruction and the disaster that war can bring about. And I have seen countries that had gone through programs that were just graduating from programs, falling back into poverty, into economic disaster because of war. So yeah, the world as it is, if there was one thing that I could achieve because I have a magic stick, it would be peace.
Do economics come into play, though? It feels different this time.
Well, you know, the wars that we have out there, and it's not just Ukraine and the Middle East, there are many other theaters of operation, like Sudan, for instance, not much talked about, that bring uncertainty and that undermine the confidence that people have. We were talking about the European consumer being uncertain. I think, you know, the uncertainty is fueled by the lack of confidence. You know, what will the future be like with those wars on the horizon and the political uncertainty about addressing them and resolving them?
Christine Lagarde, thank you so much for your time today, and we wish you a successful IMF week. Thank you.
And to you too. Thank you.
Thank you so much. If I could ask everyone just to stay seated.
And that, of course, was European Central Bank President Christine Lagarde in an exclusive conversation with our own Francine Lacroix. Meanwhile, let's get you back to this U.S. market. Of course, about an hour into the trading day, you take a look at the S&P 500. We started on a downdraft and we're still there, off by about 0.3%. Pretty contained losses, but a broad-based sell-off. But if you're looking for good news, you'll find it in the tech space. The NASDAQ 100 basically back to unchanged, maybe down 0.1%. That was your early loss leader in this market, but now fighting to go positive. And then you take a look at the bond market. Pretty quiet overall. We're just about flat on that 10-year Treasury yield. We got above 420 earlier today, but now hanging out just below that level. Meanwhile, let's switch gears here because increasing cybersecurity defenses in the era of AI is a big topic of conversation. And the cybersecurity company Okta is announcing a new initiative designed to protect users' identity when it comes to AI-specific risks. Joining us now is Todd McKinnon, Okta CEO. Todd, it's great to have you back with us, and let's put some meat on that. AI-specific risks. Talk us through an example of how you see these tools actually being useful.
Well, the potential of AI is amazing and powerful, but one thing is for sure, the threat actors and the people that are trying to hack into systems are going to use this technology to try to do bad things. If you think about the latest wave of technology, it's all about agents and agents doing work on your behalf. And how long is it going to be before threat actors try to take over those agents and take action that could do you harm or compromise your personal information? So we're all about Auth for Gen AI, which is trying to bring strong identity protection to that whole agent ecosystem.
I mean, it strikes me, Todd, that AI would be more dangerous than defensive, right? Isn't it more of a threat than it is a protection?
Well, I think like any new wave of technology, there's going to be pros and cons. There's going to be things that are very productive and make the systems more useful and more capable, and there's also going to be risks as the threat actors try to take advantage of it.
You know, at the end of the day, what are the numbers behind this? You know, you have customers including OpenAI, you're very close to the AI landscape, and even though it could propose a significant risk, I'm wondering what you're seeing on the ground today that would suggest that that would be the case.
Well, overall, if you look at the industry, we're spending billions and billions of dollars on cybersecurity tools and technologies, yet we're having more data breaches than ever. I mean, think about in your personal life, how many personal data notifications have you received and how many times have you had to reset your credit card? So if you look at the stats behind the breaches, over 80% of those breaches at the root cause or at least involved in the attack chain is a compromised identity. So it's really important that we help the whole industry lock down the identity management systems across the whole spectrum, whether it's an AI agent or a system logging in at work or the way your customers log into your website. And that's what we're all about. We're trying to bring better identity management and better identity security to the entire industry.
Well, in addition to this new tool that you've introduced, it's interesting to hear you say, of course, that you're seeing more breaches than ever, or rather, in the landscape, there's more breaches than ever, because we are 2 weeks away, exactly 14 days from the presidential election. And you sit in an interesting spot as a cybersecurity pure play, so to speak. What are you seeing, of course, when it comes to the threat landscape ahead of that election?
Well, everyone is very, concerned about every system and every process and every thing where technology is involved, and the election is no different. We have to be vigilant. We have to work with all of our partners in the entire industry to try to keep the whole thing secure and on track.
I wonder about the, let's see, poor performance of Okta stock and cybersecurity companies in general. Why doesn't the market appreciate the value of these companies?
Well, I think, short-term, a lot of times short-term thinking goes into markets, but over the long term, we believe that technology is a very important force in the world and AI is a very important force in the world. And if we work together, we can make it more secure, we can make it more manageable, and we can, over time, make sure that the benefits far outweigh any risks or any downsides of it.
But that, I mean, that's clear, right? In this age of AI and, everything in the cloud, we are all told we should be worried about cybersecurity, and yet the market doesn't really place a premium on cybersecurity companies. Why do you think that is?
I think that there is a growth in cybersecurity, and I think there are a lot of incredibly valuable companies. So I would say it's probably just a short-term view that will be borne out over the long term to see the tremendous value that the entire industry brings.
And it's interesting taking a look at your customer list. I mean, we have some big names here: OpenAI, T-Mobile, Zoom, FedEx. The list goes on. So some big partners here. I mean, as you look past the election, as you look into 2025, what are the priorities for Okta?
Well, the main thing is making those customers successful. Those customers use our technology to make sure that their employees have a productive day at work and they're secure and there's no issues when they log into their applications and they use their technology. And also making sure that when their customers log in and they use their mobile apps or their websites, that is just as seamless and secure as well. So it's all about customer success.
One thing I'm curious about is kind of business spend at this point in time, too. Katie mentioned that your customers are very recognizable names, but how are you doing with new customer onboarding at this part of the business cycle?
Well, one thing is for sure is that customers, it's different behavior than it was a couple years ago. A couple years ago, it was zero interest rates, and customers were buying technology even if at times they didn't need it. So we've seen somewhat of a rationalization of purchase and people going through the technology they've purchased over the last few years and making sure that they're getting the most value out of all of that. And I think that has been, in terms of our business, it has impacted new customer additions. But over time, one of the most critical things our customers and every customer in the world has to do is make sure that their identities are secure, and because that leads to a very solid foundation for overall cybersecurity. So over time, over the long term, identity is going to be a core foundation, and we're going to be there for our customers to provide it.
All right, Todd, thanks so much for joining us. Todd McKinnon there from Okta, talking to us about cybersecurity. Let's get a check on the markets right now. As we've been saying, today we see a down day for the second day in a row. And if we have a back-to-back drop, it'll be the first time it's happened on the S&P, at least, in 6 weeks. Bloomberg's Abigail Doodle standing by with a look. Abby?
Indeed, there is a bit of weakness here, and it is breaking up the bullishness that we've had for the most part, those 6 up weeks in a row. The S&P 500 off the lows, but still down a modest, healthy 0.4%. The NASDAQ 100 closer to flipping in the green. And then you can see the stocks down sharply. Steve Zosnick of Interactive Brokers telling Katie and I yesterday that he sees the stocks on the tell on a whole host of things, including tariffs in China, but the market itself, if it continues to be weak, that might be a sign of market weakness. Interestingly, Citi is saying something similar, but in a very different way. They are saying that short levels or long levels are the highest in such a long time that they think that a 10% correction could be ahead. If we go into the Bloomberg terminal, we can take a look at this and see that down here in this bottom panel, we're looking at the long short interest divided by yellow. We're going higher. The last couple of times when it's gone higher like that, that has been ahead of that 10% correction. So perhaps we're going to have some weakness into the end of the year or in the beginning of next year. Presidential election years are typically higher, but even if we had that, we could still end up the year higher. And then finally, movers beneath the surface, 3M, they put up a good quarter. They also raised the view. This stock now up 45%. A lot of the litigation matters behind them. Investors really scooping up this stock. Trump Media and Technology right now up. Actually, 3M has flipped to the downside. It had been higher. Now it is up down 2.4%, perhaps because it is up so much. You have investors thinking that those results that they initially thought were terrific are just needed to be a little bit stronger. Trump Media, on the other hand, to the upside, the market's way of saying that they think that the former president may have a better chance of winning on November 5th. GE down a very healthy 9.1%, almost in plunging territory. They missed sales. They raised the profit view, not the sales view. Apparently supply chain issues really weighing on sales. And then Verizon down 4.1%, not getting that iPhone upgrade that they wanted, Sonali.
Quite the choppy trade as we head into earnings season. That is Bloomberg. Abigail Doolittle, thank you so very much. Now coming up, the case for nearshoring. PlastieExports CEO Baldwin Britton discusses the benefits and challenges of manufacturing in Mexico. We're going to talk about that next. This is Bloomberg.
All right, it's time now for our daily Wall Street Week conversation. And U.S. imports from Mexico are on the rise, while imports from China are falling. David Weston spoke with PlastieExports CEO Baldwin Britton about the company's operations in Mexico and the benefits of nearshoring.
Yes, I think it's more than improving. The labor force is here. The skill set is here. Mexico has been developing engineers and has been developing people. Mexicans are extremely hardworking, very smart people that with the proper training and the proper resources, we have that to offer to the rest of the world. So I think that a lot of global companies get to know that, and that's why they're wanting to expand their operations. I can tell you that in the home appliance space, in terms of HVAC, heating, ventilation, air conditioners, appliance manufacturers, we have seen hundreds of millions of dollars just in the last 12 months of new investments or expansion of their manufacturing capabilities or factories here in Mexico. And 90% of those products, if not more, are going to the United States.
So you're seeing a big increase in your business. What are the bottlenecks in that? It sounds like the workforce is not one of them.
Not in an automated plant. Not in an automated plant.
But what about things like power? What about infrastructure? Some of the other things we hear about.
Power is becoming a kind of a challenge, but you can get your work. There is power. Mexico generates all the power. The distribution and transmission is part of things that the government is going to fix, or they're in the process of fixing. At the end of the day, we haven't had any power issues here. The amount of power that we generate is not like a data center, or that we use is not like a data center. So for our industry, it has not become a problem yet.
Does the government need to raise a lot more capital on the distribution of power? And can it do it with the government? Does it need private capital?
The laws that were reforms that were passed in Mexico, it means that all the investment for distribution and transmission needs to be government owned. So the investment needs to come from the government.
Was that going to get in the way of getting enough distribution of power?
It could take more time, perhaps, but I'm sure that we have smart people that know the problem, and they're going to figure it out and need to react very quickly to resolve the issue.
What about transportation, whether it's roads or rail? As you're manufacturing things in this plant, shipping them to the United States, how big an impediment is that?
It's not a big impediment because our close proximity to the Texas border, it's not an impediment. As a matter of fact, the state of Nuevo León just opened up Colombia and expanded the Colombia Bridge. So it's going to make it easier, much easier to export our goods to the United States.
You obviously have some business coming that you didn't have before that's coming from China. Are Chinese companies coming in to compete with you?
Yes, they are coming. They're setting up plants in Mexico. As a matter of fact, in Nuevo León, the state of Nuevo León, which is the industrial hub of Mexico, they're setting up. So that basically forces companies like us to be in our A game to compete with them. Otherwise, Chinese are very smart people, and they're going to do things quickly.
And that, of course, was Baldwin, Britton, speaking to David Weston, who joins us now. And David, I'm glad you brought us this conversation. It builds on what we were talking about yesterday, of course, with Mexico benefiting from nearshoring. Of course, Britton's company benefiting as well.
Yeah, it's interesting. As you saw in that plant there were virtually no people. It's not because it's a small plant. It's a big new plant, but they've got one person for every 10. These are injection molding machines. They're big machines the size of an Escalade that you like so much, Matt. They're huge machines, but they have very few people. It's very modern. And they make plastic parts for Whirlpool to be component parts, but increasingly for consumer consumption here in the United States. They package them up right there. They go to an Amazon distribution center in the United States, and it's what you order when you order like those plastic containers for your kitchen. They're coming right from them.
All right, so in terms of, the tariff concern, did he mention anything about how they would deal with bigger tariffs? I mean, is it a threat that, manufacturers in Mexico are thinking about?
It's an issue they have to think about because the USMCA that was negotiated by the Trump administration, remember, is up for review, not renegotiation necessarily, but review in 2026. So that's something in their minds that would really change things. At the same time, this was something that Donald Trump himself really endorsed and favored, and it has really increased the economic integration back and forth across that border, and has created jobs on both sides. The people we talk to, both American and Mexican, would say.
One thing I found interesting today is how timely this is with the IMF growth projections, because you have Mexico revised downward in terms of how fast they're expected to grow in the next year. How concerning is it if America is trying to nearshore, they're going to Mexico, and if growth is not as explicit as it initially seemed, what kind of issues does that create?
And I think that's in part because of concerns about geopolitical or political risk down there. We have a new administration in Sheinbaum, the way they pronounce it is Sheinbaum, but she's followed in AMLO's footsteps. And there's a lot of question about which way she will go on this. I actually sat down for an extended interview with Marcelo Ebrard, who's the new Secretary of the Economy for Mexico, just come in a few days before I started there. And he at least talks a great game. I mean, he says, we want private investment. We're going to create an environment in which U.S. and other foreign investors can come in and be confident of their investment. But we'll see what really happens. And by the way, that power thing is a bigger issue than actually you just heard about. They're really concerned about power because they do tend to nationalize that, and it needs to be privatized to some extent, people think, to get the distribution of power they need.
All right, well, it will be fascinating to see how it plays out. David Weston, great to see you. And of course, you can catch all these conversations on Wall Street Week every Friday at 6 p.m. Eastern. This is Bloomberg.
Exactly 2 weeks until the U.S. presidential election, and the candidates are making a big push in the swing states. Former President Barack Obama will make an appearance in Wisconsin today, where early voting starts. And, of course, Kamala Harris has been traveling around with Republicans, including Liz Cheney, to try and get some of those undecided voters, as rare and few as they may be, onto her side. Donald Trump, meanwhile, talking up the failure of the Biden administration in the states affected by hurricanes. Let's bring in Bloomberg's Michael Shepard right now. He joins us from Washington, D.C. He's following these campaigns very closely and has all the latest. Shep, great to have you on the program. Let's talk first about the decision by the Harris campaign to spend so much time with Liz Cheney and other Republicans that have come out against Donald Trump in support of her run for the presidency. Is that really where they're putting all of their eggs, that basket? Do they think it's going to bring over some undecided voters to hear Liz Cheney say she doesn't like Trump?
Well, it is part, Matt, of a strategy that aims to get any undecided voters who might be out there or unmotivated Democratic voters out there to actually head to the polls and put their ballots in Kamala Harris's favor. And on the Democratic side, they're really trying to motivate black voters who may be feeling a little bit left aside by the Biden administration over the past 4 years and try to emphasize to them that, hey, we are there for you. And that was part of the Harris push last week. This week, though, they're making a more concerted effort to try to reach some of those Republicans who are disaffected from Donald Trump and are no longer willing to vote for him, but haven't yet decided that they want to vote for Harris. Hence, we saw the vice president appear with Liz Cheney, who is quite estranged from Trump and really saw her political career as a member of Congress derailed because of her opposition to the former president. In other words, having Cheney's endorsement to say that Trump is unfit for office, but Harris, on the other hand, is. And I am here to stand by her side and tell you that.
Mike, I think demotivated rather than undecided is probably a better word at this juncture, isn't it? And if you think about some of the states that are hanging on balance, places where people may feel demotivated, particularly because they felt like the economy hasn't been serving them, that they've been paying higher prices, what's the pitch at this juncture?
Well, one of the key parts of Harris's pitch is on the housing front, because what we have seen in our surveys and a lot of our reporting, including a great piece earlier this week on the Bloomberg Wire, looking at how high housing costs and tight housing supply have made it hard for people to break in, to buy that first home, to feel like they have a piece of the American dream. And what she is proposing is adding 3 million units in housing stock over the next 4 years if she's elected, and also offering first-time buyers as much as $25,000 in incentives to be able to go out and make that purchase. Now, this is a tricky play, though, because if they don't get the supply online, it risks becoming inflationary, too, in terms of house prices. So it is a bit of a gamble. It also requires Congress to come aboard. Trump, on the other hand, is also making a pitch on the housing front as well. He is talking about finding federal land that could be made available for private housing, home construction, and then also trying to strip away some of the regulations that may be holding back building new projects.
All right, Mike Shepard in Washington. Of course, appreciate your time. With just 14 days to go until the presidential election, let's take a quick check on markets right now. Of course, still a down day, but pretty mild overall. The S&P 500 currently off about 0.3%. Big tech trying to make a comeback, not quite there yet, but the Nasdaq 100 off by about 0.1%, and the bond market pretty quiet. Coming up tomorrow on Open Interest, Coca-Cola CFO John Murphy joins us in the C-suite. This is Bloomberg.